Welcome to Dig Deep, the mining podcast. In this podcast, we go deep into mining news, hot topics, and live interviews with mining professionals and leading figures in the mining industry. Introducing your host, Rob Tyson, founder and director of Mining International and Mining International Executive, a leading global mining recruitment and headhunting agency.
Hi, mining community. Welcome back to another episode of the Dig Deep, the mining podcast, the show that brings you the latest insights, thought leadership, and stories from across the global mining industry. Today, I'm joined by Michael Rawlinson, one of the most experienced and well-known figures in mining finance and our industry. Michael's career expands multiple decades and cycles, from growing up in a mining family to early roles in investment banking and equity research. Also co-founding Liberum, senior roles at Barclays, and now a portfolio career as a non-executive director with a couple of companies. A few people have seen the industry from many angles, obviously being an advisor, analyst, investor, board member. And in this conversation, we're going to reflect on how mining, capital markets and leadership have evolved, and what generally is different about the current cycle at the moment, and what still hasn't changed at all. So there's a lot to obviously unpack there. So Michael, welcome to the podcast. How are you?
Yeah, cheers. Very good. Thanks for having me on, Rob. Great to be here.
No worries. As we always start these podcasts off, I just wondered, and obviously a lot of our audience will probably know you, but I wanted you to just give us an overview of your career. Obviously, as I mentioned, you come from a mining family, and I just wanted you to just walk us through your career, and maybe even say a few things that people may not even know about yourself. So I'll hand it over to you.
Okay. All right. Well, I was born in Zambia. My dad was working on the mines in the copper belt there for Anglo. And, in those days, these remote mine sites were not kind of remote at all. They had, wonderful facilities for families, and, there were clubs and social clubs, and there was a huge population of expats in there. And I had a sort of great time, great childhood. We then moved to Ghana, Sierra Leone. My dad's last job in Africa was in Guinea. I had to go to boarding school for that patch after my mum taught me at school a few times. The West African years were not great for our family, though. Each time my dad worked in a diamond mine, there was a coup. The mine got overrun by sort of nefarious types, and the whole thing got shut down, and he lost his job. That happened 3 times in a row inside a decade. Which is it's quite interesting. Here we are back again in West Africa, and there's a coup seemingly every 3 months, and mines being shut down and whatnot. So who says things don't change there? But anyway, you would have thought that it would put me off mining for life, but no, not at all. I went off. I actually did a degree in economics, a master's in resource economics, actually. And after a failed attempt to set up a Japanese restaurant, I went into the city. Started off at Fleming's, which was an old-fashioned Scottish investment bank, which actually got taken over by JP Morgan. I worked for the great Ian Hannam and Roddy Fleming, and in my first years in the mining team there, and we worked on lots of schemes to try and get Billiton to London and other sort of African deals. And I decided I wanted to get a bit closer to the mine, so I became a research analyst at Cazenove. And at that time when I joined in sort of 95, 96, there was only one mining company on the London Stock Exchange, and that was Rio Tinto, and it was in diversifieds and other as the sector, which is, so it was an unusual role. I covered the South African names, but Cazenove was a very strong stockbroker. It was 44. It was brokered to 44 of the FTSE 100 companies, and it's a natural place for all these relisting companies that wanted to come to London to use as their broker. So a lot of them were being done by Ian Hannam at Fleming's, later JP Morgan, and they often used Cazenove. So I was involved in a lot of the big listings. So we did Billiton, we did Anglo American, we did Xstrata, Vedanta, Kazakhmys, and a whole range of others. And at one time, we were brokers to all 8 of the FTSE 100 mining companies. So it was an amazing time to be there. Although in the initial years, right up to 2000, I was, the mining was a backwater, the tech bubble was happening. I actually wanted to become a tech analyst, but I stuck with it, and the sector began to change. The listings started to happen, and it boomed, and it was a great time to be there, being involved in all these listings and some of the big M&A deals at the time. So, I became a partner at Cazenove, and then it got sold into a joint venture with JP Morgan. And I moved into investment banking, did a bunch of listings and M&A deals. The biggest one was Xstrata Falconbridge, which was just an incredible deal. The fees were $300 million for JP Morgan, which was just top of the cycle. It took a long time before I ever got paid more than I did in that year, I tell you. And that was my time really at JP Morgan. And off that high, a group of friends at Cazenove, they'd heard about a guy who wanted to set up a small investment bank, Shane, and I decided to join them. And I was one of the founding directors of Liberum, sort of left everything behind at JP Morgan. At the top of the cycle, there's 3 years deferred bonuses and all the rest to go to a startup with not very much money, no track record, nothing. And, at the top of the cycle. And, a year later, we had the financial crisis start. I had 3 young kids, just bought a massive house in the country. It was a very stressful time. But we had great fun building it, and a real sense of achievement. It also introduced me to the world of smaller cap companies and doing stuff with smaller companies and the crazy entrepreneurs that you get in mining, and the people who became way richer than any banker can be if they sort of find a project, take it through the various hoops, get it to production or sell it even before production. And it really opened my eyes to some of the opportunities there and some of the riskier things that we've done. And, we're associated with great successes and some pretty horrendous failures as well. But it was a really interesting time. And I kind of really enjoyed it. I saw the sort of the broking world, though, in the junior end in London as a capital market, it was just getting tougher and tougher. And so when I got approached by an old friend to go and head up the global mining team at Barclays, I thought, it's a big seat. I'm not sure I'm going to enjoy it, but let's have a go. So I did that for a few years. Difficult time to join Barclays. They just had the LIBOR scandal. They fired the old CEO. The new guy, he didn't like investment banking. So he was sort of shutting down a lot of the businesses that I joined to learn about, really. The commodities business, the mining project finance business. They had offices in places like Russia and Peru and Brazil and Australia, which are all very important to mining. They all got shut down. And so, and then the final piece was they sold Barclays Africa, which is an amazing franchise. And I love the African side of the business, given my roots there. So it just sort of ground me down a bit, really. They treated me well, but it kind of wasn't for me. And I just decided, well, I've sort of done, I think I'll leave investment banking. They paid me out, which was wonderful of them. They said, you can leave and get your money as long as you never become an investment banker ever again. Where do I sign? So I went off and decided to start off as a non-exec career. I'd been approached by a company that had helped float Hochschild Mining to be on their board, and Barclays let me join it. So I'd had some experience, and when you make a career transition to plural, the first getting the first NED role is actually quite tricky because you've got to be seen. It's easy to be on a list as NEDs if you've done it before, and it was a real gift that I'd had NED experience before I'd left the mothership, as it were. So I after Hochschild, I joined the Capital Board, which has been a fantastic story. Mining services, drilling, and labs, and also mining. Big global business, which we helped float when I was at Liberum. So I knew them well. and then I joined Adriatic and Andrada, and I've had my ups and downs in the the NED world, but the Hochschild and Adriatic ones are the ones I've been most proud of. Really, they've been very exciting, and obviously the Capital one is a story that I'm still very much involved with, and it's going strong. Most recently, I've joined the board of Goldfields, which is properly eye-opening and storied. It's a company that is coming up to been around for nearly 150 years, and in 1898, I think it was the world's most valuable company. So it was the NVIDIA of its day. I think it had been founded by Cecil Rhodes, and it was the most profitable company in the world back then. So it's interesting to end up in a company that's been so storied and clearly has done some things right to survive all this time. So that's me so far.
Yeah. Appreciate you sharing your story. I'm going to take you back because I can probably hear a lot of the audience shouting out. How comes you got involved in opening a Japanese restaurant?
After my undergraduate degree, I went. I worked for a bit in America, and then I went to Japan. I had a girlfriend doing what they call the JET program back in the day, and she was living up in the mountains somewhere, and I went to the nearest city, which was actually Hiroshima, and I learned how to become a TEFL teacher, which had great fun. And one of my guys that I taught, I think he was a Yakuza. He had a little pinky missing, I said, I'm leaving, going back. I love this food. I think you set up a restaurant. I said, I'll back you. So I came back. I signed up for my master's, and so I was at college in London, and then I found a site in Soho, and I came up with a business plan, and he came over to do it. And I just think, I think the end of the Japanese bubble was coming. So maybe he had his problems, but he also could see I didn't know what the hell I was doing. So it didn't work out.
Right. Got you. Obviously, you've explained there, obviously, your career. If you look back, what have been, I suppose, some of the defining moments that has shaped how and what you think about mining and capital in today's market?
Yeah, I don't know. It's interesting. I suppose the world of mining is, it's the oldest, most boring, most basic of industries, and in a sense, it never changes. It is the most volatile sector there ever was. The cycles are brutal; they're relentless, and it kind of creates the opportunity. And for a lot of people, it just puts them off your average investor. But it's actually the key to making money in it, and actually knowing who to work with and take those opportunities with can be the keys to an exciting, prosperous life in a way. Yeah.
Over obviously the course of your career, what are the most meaningful ways the mining industry has changed? Whether that's around obviously safety, could be scale, fly in, fly out, ESG, sustainability, permitting, and all of that. Where do you think progress has been real versus overstated? And then obviously, just as importantly, what fundamentally has changed?
Yeah. I mean, I think it was a bit Wild West, especially at the junior end. People could come in, build mines, dangerous mines, using a lot of people that killed a lot of people, left horrible environmental scars behind. It was pretty sexist, stuff like that. I remember going to a platinum mine site visit, and we all had vodka shots before we went underground. And then we were hearing about, they had a good year. They only had X number of fatalities that year. I mean, it really has changed a lot for the better in that sense. I mean, obviously having better safety, environmental, better governance and regulation has meant things like permitting is taking so much longer, which is I think has a risk of making some of these cycles more violent. It's also made some countries be losers. The US, Canada, their share of mined commodities has gone down since when I started, at the expense of places like Indonesia, China, where there's less of a break on that kind of thing. But some areas that do things, some places that do things properly, like Australia, have really flourished, and some places that still have the rocks and don't necessarily have the regulations have done badly, like South Africa, where there's been a real governance problem, I suppose. So I think that so there's been some winners and losers. It's overall a better place. I mean, clearly, in a sense, it's a smaller industry, number of people, share of GDP, but the tons grow for most commodities just a little bit less than GDP. The amount of tons you need of rock to get that same amount of copper or gold, that's going up by more than GDP because grades declining and so on. So it's getting a bigger industry, but it's just more and more capital intensive, longer term, bigger business, and so it's kind of more grown up. And I suppose that it's changed in a sense who provides the capital a bit as well, in that it's had to become more professional because you need deeper pockets, more sophisticated investors that know how to assess these risks and do it properly. And that's probably a good thing. But things like the London capital market has lost out a bit. I suppose the things that haven't changed, though, is the cycle, right? I mean, you've had this grinding demand growth that sometimes speeds up a bit, sometimes doesn't because of things coming along like China or AI or whatever. But the cycle really comes about because of massive oversupply and capital that comes when you have very high prices, and then mines get built, and then you get oversupply, and prices fall, and everyone gets put off from investing, and it takes about 20 years for that to self-correct and people to start investing in projects again, and they take a tremendously long time to deliver. So we have these deep cycles every 20, 30 years, and we seem to be having another one. And we had one in the 70s, one around the 2000 sort of 6, 7, 8, and now we're entering a new one. But that's metronomic, right? That just hasn't changed. And the geopolitical macro nature of this sector hasn't changed either. So that's what makes it interesting.
Yeah. Obviously, you mentioned we talk about mining finance and obviously how capital markets and especially the role of London and private equity. And again, I suppose the balance between specialists and general investors have evolved. What does that really mean for companies that are trying to raise capital in today's market? Because there's so much movement, different investors coming in. Yeah, just wonder what your thoughts are on that. And as I mentioned, the London market as well, which obviously you're experienced in.
Obviously, when I started the London market, there was no mining finance. I think it had been big in the 70s, and it had died and withered by the time I kind of came on the scene in the late 90s. But then it flourished again with the globalization and people coming to London. And then it's withered again. Some of those companies being delisted, the Kazakh Misses, the Vedantas, and the New World Resources, and some of the juniors just didn't do very well. People lost a lot of money. It's been a disaster kind of thing. And other listed equity venues have done better, but I just think listed equity is a tough gig. Australia has done really well, and I think their superannuation system has created a deep pool of capital, and that capital is kind of incentivized to invest in the UK, in Australia, unlike in the UK. I mean, did you see the parliamentarian pension fund has a 4% weighting in UK equities?
You know that.
these superannuation schemes in Australia, they're like 40-50%
Yeah,
Australian equities. And like we supposedly, our government that wants to back UK business and 4%. And
nothing.
that's your average weighting, right? And when I started, it used to be much, much higher, all these pension funds. And so people are just, the globalization of Britain has actually just meant the money's gone elsewhere, and investing in equities. And they've been poor equities, and I kind of get that. So I can whinge about the sort of the London equity market, but there's something wrong in the London equity market, which is very sad. But that said, the way mining companies get financed has changed as well. When I started, the mining private equity hadn't really been invented. The streamers hadn't really been invented. And now, and partly because you've had, the specialist mining funds or generalists that would support mining companies. If you had a decent project, you could maybe spend a couple of days wandering around London, get 20 orders in the book, each for 5%. And that would get your equity to build a mine. There'd be a project finance bank providing the project finance, and you'd build your first mine. Those 20 names are now down to 3 or 4, the mining funds we all know of, the BlackRocks, etc. And even they have much higher hurdles in terms of liquidity, so they can't play in the smaller names. The project finance banks, the number is really reduced to a very small number. So really, private equity is where you have to go to get your cornerstone. If you're listed, and the Appians and the Tembos and the Orions, and they're all very sophisticated, and they give a lot of comfort to the generalists, the people who've got much more experience and skin in the game, have done the work. And so it's possible, but it means you have to go to them first. And I think that's progress in a way, but it's just this gradual de-equification. I mean, perhaps it comes back, but I think we need government help, I think, to the equity markets to make it more vibrant, like in Australia. I mean, in Australia, we've had loads of listings and lots of people made lots of money. And then a bit like how it works in California, where there's tons of tech startups that have made tons of money and people have made tons of money, so they reinvest it back in the sector. We haven't had any wins in the UK, so there's not much reinvesting. Changing a bit, things like Adriatic and others, but that was, very much in part an Australian story, right? That's where the risk capital came from that. It's a shame, but London has a sort of strange allure. We might be losing non-doms and other people, but the Capital Markets Day for Vale, the Capital Markets Day for Goldfields, these are international companies, not based in London. They did take place in London. And it's seen as a mining hub. Some of those private equity firms I talked about, they're based in London, right? It's still a hub, and it's in the right time zone, but it's been chipped away by the Middle East, and but it's kind of not right that Australia is the only place that's really working well for mining in the world. Needs a bit more balance, I think.
Yeah, I was just going to follow on from there, because I think a stat probably 5 or 10 years ago that 80% of the money from the mining industry came out of London, and obviously I think that's heavily reduced now. How do you see the outlook for finance within the London markets now and moving forward? Because obviously I see a lot of commentary where people are struggling to raise finance out of London, obviously going to different markets. How do you see it at the moment? Is there money here? And there might be certain pockets of money. And how do you see that evolving? Obviously, you mentioned about the government, only 4% of the pension funds are going into the sector. Do you think because of the need for all these critical minerals and
No, it wasn't for the sector. It was to the UK.
Oh, okay. Okay. Do you see that? Do you see government increasing their spending within our industry to meet the demands, the electrification demands, and having critical minerals within the UK also?
Yeah, firstly, I think that London got a big share of the global, if you like, raise in mining because it attracted some of the enormous listings, and companies like Xstrata and Glencore, and that was another one I was involved in. And when they come, it's billions being made, not tens of millions. So you need 5 or 6 deals, and then suddenly you're top of the tables for many years. And we had those 5 or 6 deals, and those companies, most of them are still around. But they're quite well funded. But if we get big M&A, you'll get those big tickets. London is still a great place for raising large amounts of money for producing companies. But these companies have learned their lesson. They've got good balance sheets. They don't need to come back. They're being disciplined on M&A. So it's people kind of forget that we were this place that raised lots of money. We weren't that great at raising lots of money for junior companies. The ones we did, they weren't fantastic. And that's, I think, the bigger problem. How do you get the great quality companies? And, you have a great infrastructure in Australia where, you got all these mining schools where there's geologists and lots of people who work on the mines who end up working in fund management curves or broking firms who kind of know their onions. Find the experienced mining people who are mining analysts or buy-side people. They're sort of few and far between. They're in the private equity funds, but they're not in the generalist funds. And I think people in the fund management firms quite rightly like, well, how do we really know, what this person, it's a very technical sector. Not being aware of the risk was what undid us last time. So I think to the extent we don't have lots of people coming around, I think the junior end financing stuff, I think it will be led by the private equity funds with top ups from London, because they're the people doing the work, if you like, that validates each deal. The second part of your question was around the UK. The UK's potential to be a player in mining is pretty small. We've got down in Cornwall, we've got obviously some tin and some lithium and bits and bobs down there, but these are really small tonnages, really small scale things, tungsten, etc. And elsewhere, got the Stalled Potash project, but it's not like there's tons of big things coming. And, if even some of the gold things we're looking at Scotland or nickel, some of the things I've invested in, they're small scale stuff. We're not going to be a big player.
Yeah. Obviously, we've mentioned about cycles, and obviously every cycle claims to be different. From your perspective, how does the current cycle truly differ from obviously previous ones? And I suppose particularly in terms of supply constraints, capital discipline, geopolitics, which is obviously pretty big at the moment. And if you look at obviously AI, the energy transition, and the speed of price movements, are the parallels closer to the mid 2000s or further back into the 1970s?
Yeah, no, very, very much so. I think on the supply side, they're pretty similar, 70s, 2000s, in that you have these big booms in the 70s, and then 2006 to 8 or whatever, where huge amounts of capital went in that created a supply. Some of that investment was bad. It put people off. It drove down prices, and no one wanted to hear about the sector ever again, kind of thing. Meanwhile, demand grinds back in the background, and then people start getting interested when something exciting happens. In the 70s, it was an oil price shock, and there was a sort of strategic scramble for strategic assets, if you like, and there was some geopolitics with the Cold War and whatnot, that was driving some of the spending. In the last cycle, it was China came along, and it was incredible demand growth, especially for the bulks, for iron ore and others, with that industrialization and steel build and coke and coal and whatnot. This time round, the nature of the demand is not so much the bulks. It's back to a bit more like the 70s, where you've got your new, it's a theme. It's AI, it's energy transition. So it's, a lot more copper for electrification and energy transition, things like tin. We're going to be short power, so things like uranium. aluminium is flying because of energy shortage, those sorts of things. And then the other similarities from the 70s is, we've got ultra profligate governments spending tons of money. It's kind of inflationary. We have a huge debt bubble that they have no intent to control. They're talking about yield control and pushing down long bonds. So people are sort of worried about debasement, the debasement trade, which was all about the 70s. That was the era when, Sean Connery was in that movie Gold. People cared about gold then. And now they care about gold again now because it's real hard stuff and people are worried about the dollar and obviously geopolitically with what happened post-Ukraine with the threats of people freezing assets that are financial assets rather than hard assets. That's only added fuel to the fire. So I think, there are aspects about the 70s that I think are more relevant now. And, it's amazing how the geopolitics have really started to come through, export bans on products, they're creating huge volatility. We had cobalt last year, we had rare earths, we've now got Indonesia with tin and nickel, even silver export ban from China. People are having to think about, well, where are the inventories? How much does everyone want? Are they going to be strategic holdings? And it just creates more demand because people are now thinking buffers, stockpiles, and all the rest. And then the next stage is like, well, I need to have my own mine and support my own mine, which is where the US is sort of backing up and really sowing the seeds for the next downturn because you're building mines that shouldn't be built just because they're in your backyard rather than somewhere else. This is, sowing the seeds for the next downturn, but let's enjoy it whilst we've got it.
Certainly. As we mentioned, and as you mentioned in your introduction, obviously you've been in research, been a research analyst, a banker, investor, and obviously more of a non-executive director. Which role would you say you've actually enjoyed the most? And I suppose what did it teach you that still influences in how you actually operate today?
I think I've enjoyed all of them. But the highlights for me in research was all those listings and IPOs and M&A, and that was a real sense of you're creating something. You're financing things and getting things done, and it's great to be working in a boom time. Liberum, that was also fun, but the sense of achievement there was really setting up something from scratch. It's the highs are incredibly high, the lows are horrible, but when you step away, you look back. There's a firm when you started with 3 people, and it's 150, and it's got revenues of 50 million, and it's profitable, and all that. It's a real sense of achievement. And then the actual being associated with companies, that's been great fun. And again, I suppose the things that I've enjoyed the most is when you've had real challenges to get through to create a great result, and to be associated with Adriatic, where I joined as a non-exec after becoming an investor when it listed in Australia. When I joined, it was still an exploration company. I think it just done its first maiden resource. And we went through another resource update, a PEA, then a PFS, then a DFS, then a financing, and all the way through COVID and all the dramas that had, and building a mine through all of that, and then all the horrible permitting issues and questions about constitutional courts and hoo-ha, and getting it done, because of, in that very tough environment, to result in something that's now producing, employing a ton of people, very profitable, and now sold to a great custodian. It's been a great story. It's a unicorn, right? To be associated with a mining unicorn that's in 8 years gone from nothing to, what probably now implied value over $2 billion is such a great thing. And clearly, I was just the chairman. Paul was the guy who had the vision and got it done, and Laura kind of finished it off. But to be associated with that, it's been a wonderful experience.
Yeah. And I suppose in such a short space of time, actually from nothing to operating mine in, what was it, 10 years? I mean, 8 years. So there's not many stories like that out there.
No, and it's not like it was straightforward either. It's, new jurisdiction for mining. They hadn't built a mine for 30 years. The code had to be updated as we were going along. Language issues, COVID, a proper achievement. Yeah.
Yeah.
So,
Obviously, more recent now. Obviously, you're in the boardrooms. What do you think boards still get wrong in obviously in our industry in particular?
quite a lot.
And obviously, when it comes to capital allocation, risk, obviously timing across the cycle, where do you see non-execs add the most value when things obviously aren't going wrong? I mean, when things are going right, it's great, but when it's not going right, where can
Yeah.
non-execs add the most value?
Well, sadly, the board's got a few roles, right? The boring bit, which are the governance, the risk, and the controls, that's like foundational. And then beyond that, it's like hiring and firing the CEO, setting the strategy, and then making sure the crown jewel decisions are the right ones, But the controls are really important. Have we done the work on safety and the protocols, and have we done the work in the environmental, and have we done the work on the social and the whistleblower systems and the financial fraud and all that? Because any one of those things, like an environmental has a safety issue, a social issue, fraud, could be over, right? And that's the board oversight bit on that is really unglamorous, but you kind of got to do it. And but if that's all set up well, and you've got good internal controls on all of those things like safety, and internal audit, and good ESG policies and all that, you can then think about the fun stuff, which is your strategy, making sure you got the right CEO and they're working well with the management team, and that's when it becomes about strategy and the decisions you make. And, you've really got to guard against the cycle, really. When it feels great in the cycle, you can take over the world, and, people do crazy things, and the board's there to stop that and remind people and all the rest, and stop the crazy deals. And similarly, when you're working for founders and entrepreneurs, they're born optimists. They run through walls. They always think they can do it quicker than they can, and so being cautious on balance sheets, funding, making sure that there's enough money, because the market just hates running out of money. And so just if the management say X, add 6 months and 20% to the budget. It's just the right way to think about stuff. And then on M&A, it's be really careful at the top of the cycle about doing stuff, because everyone will love it and all that all makes sense until it sort of doesn't when the cycle turns. And similarly at the bottom of the cycle, when the spreadsheet nutters are sort of saying it doesn't work, you'll never make any money. The price of gold's 1,800 and it's MPV not accretive at this price. Push through if you've got conviction, because your risk at the bottom of the cycle is so much lower doing a deal than at the top. And of course, at the bottom of the cycle, everyone's terrified of doing stuff because they're worried, but you should be terrified at the top. So yeah, it's those sorts of things. And we never get it right on boards, and never underestimate the bigger the board. You've actually got to collectively get everyone on board, so making big decisions or stopping big decisions is actually quite tough.
Yeah. And lastly, and if we look at obviously the younger generation, so younger mining professionals coming into maybe the mining finance, or want to aspire to eventually maybe be a CEO or even a board member, what skills or maybe experience or even mindset shifts do you think matter? And mostly I suppose in today's environment, what do they need? And also, what advice would you give anyone that is looking to move or look at their career in, say, 20 years' time, if they're obviously more coming into the industry? What kind of things should they really be focusing on now if they're looking 10 or 15 years out to be a CEO or even a board board member. And I suppose this is from your own experience and what you've learned going through the system.
Yeah, I mean, I think first of all, do think about joining the mining industry. It's tremendously interesting. You've got the cycles and the macro, but you're traveling around the world. You're working with interesting people doing big important things. The world falls over if you don't have mining and metals. And two, if you're thinking about going into some sort of service thing, like finance, law, or accounting, AI will have your job. In mining, it will not. This is real stuff. This is revenge of the high vis vest land, right? The next 20 years, the people who've learned the skills in these technical industries, they're going to do well. So I think I'd actually start, if you're thinking about mining finance, get some work experience in the industry first, be it in exploration, in production, get out to the mine sites, understand the game. It'll give you credibility later on and really make you understand, and you may love it and you may stay. There's tremendous value in the industry. And then just try and get experience. The people who kind of rise to the top, when you look at their CVs, they've often done a bit of an exploration, they've done production, they've been in commercial, they've done M&A, they've been in financial control. And so when they come to be the CEO, they've worked in every department and they know a little bit about all of it, and they can connect and react. So yeah, don't overcome that imposter syndrome thing. I can't do that. You can have a go and move around the industry. Get lots of experience, try and work for high quality companies and learn out all of their systems and processes, and you'll do well. It is about taking the opportunities when they come and sort of backing yourself in rising up in a career. And if it's 4 or 5 years in one job or 2.5 in one and 2.5 in another, always take the 2.5 and 2.5. With mining CVs, they look incredibly chopped up because it's difficult living in, I don't know, one remote place for more than 2-3 years, and everyone gets that. And then you want to move and maybe move to a desk-based role somewhere or move to a different country. But that's the joy of a mining career. You get to see the world and meet some interesting people.
Yeah. Got one more last question. How do you see the mining industry from today's perspective moving out, say, over the next decade? Where do you see, I suppose, how do you see it evolving? Where do you see opportunities? Where do you think there's probably more problems and challenges? So I suppose just giving an overview of how you see the mining industry developing over the next decade.
Yeah, thinking about this it's quite interesting. Think about which countries are actually going to be building mines, and where there are going to be mining industries, because that's where the opportunities will be. And I find it interesting that US moved away from all of that, and now they're trying to get back in, but there's no skills. So there's clearly some amazing opportunities to be had in America. There's a desire to reshore, to develop. They've got the resources. They've just done nothing with them for a long time. And it's a pretty stable jurisdiction, notwithstanding the noise of the current place. I think Canada and Australia will remain good places to be. But I think Africa, it's always like this. If you go and work there, you may lose your job. It's a tough place. Big companies are finding it difficult to find reasons to invest there. And it's not a bad place to explore and find stuff, but you're often finding that the companies, if they get to the end of the road of developing something, they then have to sell to the Chinese because they're the only best people who are there. So it's the opportunities in Africa, I'm not sure as much about. So geographically, commodity wise, I mean, clearly the industries that are growing way faster than the GDP is lithium, but that's becoming more of a DLE thing. So it's sort of, people from the oil industry seem to know more about how to do that than people from the mining industry. But copper's going to be huge. So to be in that sector is great. I think the death of nickel's sort of overstated. So I think all of the base metals are fine. Iron ore, the Pilbara is going to be going for a long time. Some of those things in West Africa, I think that's all good. I think coal will gradually decline, but it's going to decline less than you think. I think young people are not interested in working at coal mines, are they? So, there's plenty of places. I wouldn't be surprised if the FSU comes back into our lives. Putin's not going to live forever, and what happens after that? Does he come back into the fold? There's huge opportunities in the former Soviet Union, and it's not such a bad place to work. So I don't know, but we've gone from this for the next 20, 30 years. I think the incremental demand for commodities is going to be very good with with AI and robotics and all these sort of things driving demand, industrialization of India. But thereafter, the world starts to shrink. So the latter stages of your career, you learn about recycling.
Yeah. Yeah. And I think it's a lot easier than mining. So a lot of people have been telling me trying to start a mine is a lot harder than just starting a recycling plant.
Yeah.
Yeah.
Exactly.
Great. Michael, really appreciate your time. Thank you for obviously sharing your story, sharing your insights on obviously the various topics that we've obviously spoken about. I know you're a busy person. You're probably out there at various conferences during the course of the year. But if people want to follow anything that you put out on social media, is there any places that you particularly, in terms of social media land, hang out or not at all?
I'm a lurker.
Okay.
I'm not really, but I do put stuff on LinkedIn, so you can catch me there.
Yeah, no worries. Well, I really appreciate your time. Thank you for sharing your outlook, and maybe you want to come on the podcast next year and give us an update on how you see how things have changed then, because obviously a lot of things are changing all the time and we could be having completely different conversations. So be more than welcome to have you on the podcast sometime next year.
It's been fun. Yeah, great.
No worries. Thank you. Thanks for listening. Hope you enjoyed that episode. A lot of content to unpack there, covering a lot of different topics. Obviously looking at jurisdictions, looking at commodities, geopolitics. There's a lot to unpack there, cycles. So really appreciate if you can share this episode amongst people within our mining industry. There's a lot of education there, and I'm sure anyone that's listening will pick one or two things up that they may have not known before. So thank you for listening. Appreciate your continued support. And until next time, happy mining.
Thank you for listening. Remember to reach out to Rob via the show notes and be sure to subscribe and leave a review. Until next time, happy mining, helping each other to improve the mining industry.